In this video, we're going to continue our discussion of financial statement analysis. So first, we're going to kind of talk a little bit about the differences between fixed assets and current assets. So let's think about which do you think is more sensitive to external events? Current assets or fixed assets? Well, I think it kind of depends on the company itself. I mean, current assets are going to be affected by short-term economic shifts. Fixed assets are going to be a little bit less sensitive, but in the end, because of the dollar amounts, longer-term economic events are going to have substantially more dollar impact on the company. They refer to something here called a self-liquidating loan. Right? So this is a loan essentially to support current assets. So if you need to buy inventory, how do you do that? Typically, you do that with something called an accounts payable or a short-term loan. And the idea is that when the inventory is sold, the sale of that inventory is going to pay for the purchase of the inventory. So, let's assume it costs $70 to build something that costs $100, right? So you have $30 in profit. So if you sell this product for $100, what happens to the first 70? The first 70 covers the purchase of the raw materials to make the product itself. So what happens to accounts receivable and inventory when sales go up? Well, certainly accounts receivable increases, but if we expect sales to continue to increase in the future, inventory itself may go up. But if sales are going up and we don't increase inventory growth, then inventory itself might decline. So let's look at a series of ratios. We talked about these a couple of minutes ago. These are what are referred to as the turnover control ratios. And I had mentioned a little bit earlier about this inventory turnover ratio is kind of hard to understand. They refer to DIO as days inventory outstanding. This is on average, how long does inventory sit on the shelf? I think this is easier to understand. Roughly, the average piece of inventory is on the shelf about 28 days. So, again, we can manage and look at these ratios as efficiency types of ratios. They describe activity. But they are important ratios to understand the overall performance of the company. So let's kind of switch gears and talk about a set of these. The average length of time between when cash comes in the door and when cash comes back in the door. How long, when you buy something, cash goes out the door. So that is when company acquires inventory. Now, how long does that inventory sit on the shelf? And we said for Hasbro, 28.2 days. Now, once it's on the shelf, eventually it gets sold. Most assets are sold on accounts receivable for companies. So how long does it take for people to pay us? That's what's referred to as the collection period. What was that for Hasbro? Collection period was 96.0 days. So add these two together. That's 118.2 days. So on average, from the time you buy the assets to the time you sell receive the money from the sale is roughly 118 days. Now we also are going to pay for this assets, right? We have to pay for these, the purchase of inventory. On average, how long does it take the company to pay? So if you look at the payables, it's roughly 52.4 days. So you take roughly what, 118 minus this 52, that's 68, that's 58 days roughly is what it takes for the company to convert this cash. So the segments, the operating cycle is days inventory outstanding plus the collection period. The cash conversion cycle, you subtract the operating cycle, you subtract from that the payables period. So how do we analyze this number? What we would like this number to be is as close to zero as possible. Even negative, right? Even negative wouldn't be terrible if it's a short enough time frame. But we want to get our money as quickly as possible. We want to slow down our payment of money as much as possible. So again, we like this number to be as close to zero as possible. So here we have Hyundai. And again, this is one of those you try it things. You're going to pause the video and do the calculations here. So you're going to have to calculate those three ratios. And in the end, you're going to find out that this cash conversion cycle is a total of 48 days. It takes roughly 82 days for the operating cycle. And then you subtract out the payables number to get to your 48 days. Now, is that good or bad? Well, it depends on the company. It depends on the industry. Again, we would like this number to get closer to zero as possible without damaging the company. Let's come back and think about this financial leverage question again. And they ask a very important question here. And the question is increased leverage a good thing? Well, let's see if we think on simpler terms. Is debt bad? And the answer to the question, especially in the business world, is absolutely not. A company cannot survive without borrowing some money, right? They're going to need to borrow some money. There are very few companies that have been able to expand to the corporate entity side, right? Think about companies like Kroger, P&G, Apple, Microsoft, General Motors. You cannot get to that size without borrowing money. So the more important question is, there's actually two questions. The first question we like to answer is, how much debt does the company really have? And the second question that we'd like to ask is, given how much we've borrowed, can we control that? Can we handle that amount of debt? In other words, is that amount of debt bad for the kind of business that we are running? So how do we measure this? The first question, how much debt do we have? Well, there's two ways to look at this. We can look at debt to assets. This tells us the percentage of assets paid for by creditors. We have total liabilities divided by total assets. Now, this number has to be less than 100%, because obviously there has to be some debt or some ownership in the company. So again, the bigger the number, though, the greater the amount of debt. Again, is that good or bad? The only thing I can say for sure, just knowing this number, is the company in a relatively risky position or not? I don't know that it's good or bad because I don't know how the company manages this amount of debt. The other thing we have here is debt to equity. Now, This particular ratio is total liabilities divided by shareholder equity. Again, relatively speaking, if you look at the right-hand side of the balance sheet, what's the relationship between debt and equity? Now, there is another version of this debt-to-equity ratio that, quite frankly, I prefer, and that is long-term debt divided by shareholder equity. This looks at the company's long-term financing and compares the debt portion that's long-term to the equity portion. So relatively speaking, if you have a lot of debt, right, then you want to know, is that debt short-term or long-term debt? If it's short-term debt, that's not so bad because by definition, it should be paid off within a year. But if it's long-term debt, now that's a much riskier position that the company might be in. The second question that we talked about is, can I handle that amount of debt? And there are two ratios that help us with that. One's called the TIE ratio, or times interest earned. EBIT, which is operating profit, divided by interest expense. Now, the other ratio takes care of one of the weaknesses of TIE. That is, it includes principal repayment. Now, depending on the kind of debt the company has, this difference might not be that important. Smaller companies, companies that have a lot more debt on things like mortgages, maybe cars and equipment, things like that, that have taken out loans, rather than companies that have bonds that are obviously much bigger. The smaller the company, I think times burden becomes more important. But in general, the bigger the number implies that a company should be able to make payments on their debt. So a couple other leverage kinds of ratios. So let's look at what they refer to as the market debt to equity ratio. So what is the market value of debt divided by the market value of equity? And this gives us a picture of the relative financial value between those investors who are creditors and those investors that are owners, right? I guess another way to kind of think of this, sometimes they refer to things called safety margins, right? Or how much room do you have, right? The lower this number, the lower the amount of debt. That means the creditors own less of the company than the owners do. However, if it's more than 100%, that obviously means there's more creditor money that's being used than owner money. In addition, we can just add to the numerator. You also want to add down here debt. So again, this just gives us our overall relationship of how much debt we have, market value sense, compared to the total market value of the company. One question is, what if you don't know the market value of debt? Well, typically we estimate this by looking at the long-term debt number in the balance sheet. Now, you do have to be careful here because we don't want to include some of the things they might include in long-term debt are things like some intangible things, some goodwill. Sometimes they're in there in the debt, not goodwill. I'm sorry, I didn't mean to say that. They have some line items there like minority interest might be considered a debt, and it's long-term. So you want to look for that number that represents the amount of long-term financing in things like loans and bonds. But again, it gives us a relative picture of how much debt we have. Now, switching gears and looking at the short-term perspective, we want to look at what's referred to as liquidity. And there are two basic ratios that we look at. The current ratio is current assets divided by current liabilities. Let's think about the definitions of these two items. Current assets, by definition, are all of those things that you expect to turn into cash within the next 365 days. So this essentially is cash. Current liabilities are all the debts that are supposed to be paid in the next 365 days. So they are essentially bills. So this ratio essentially represents cash compared to bills. Do you have enough cash to pay the bills that you currently owe? Of course, we want this number to be greater than 1. If it's not greater than 1, it doesn't mean that the company is bankrupt. And in fact, depending on the industry, it doesn't even mean that the company is necessarily in trouble, but it is something for us to reflect on and to try to understand, how can I get it above 1.0? As a general rule, we'd really like this number to be closer to 2 or better. But again, it really depends on the industry, and it depends a lot on the company itself. Now, the acid test, or the quick ratio, subtracts out inventory. So if you take current assets minus inventory, inventory is a little bit more difficult to get rid of than accounts receivable, and cash is already cash. So this just talks about what they refer to as very liquid assets and divides that by current liabilities. So it's just a more conservative measure. The important aspect of this ratio is, how much inventory does the company have? Certain industries have a lot more inventory than they do plant and equipment even. Think about a grocery store, right? If they don't own that building, they still have a tremendous amount of inventory. So when you subtract inventory out of this ratio, this number drops dramatically. So if you have an industry where you sell lots and lots of things at very low profit margins, the acid test ratio is going to be dramatically lower than the current ratio. But if you have inventory that's a little slower, higher priced items that typically have higher profit margins maybe, then those things are going to have a higher quick ratio. Still not above the current ratio, but it will be a higher number. So again, we've looked in this video about leverage, long-term kinds of leverage, and now we've explored the concepts of liquidity. Look forward to seeing you in the next video.